Every morning, millions of people wake up thinking today's the day they'll make $1,000 before lunch, all from their laptop. No boss, no commute, just coffee, charts, and chaos. That's day trading, the financial roller coaster where some actually make money, and most, well, end up learning what the word volatility really means. In the next few minutes, we'll break down how day traders make and lose $1,000 a day and uncover the truth behind the screens. Day trading sounds exciting, and it is. It's the art of buying and selling financial assets like stocks, currencies, or crypto, all within the same day, to profit from small price swings. No long-term investing, no waiting for dividends, just fast moves and faster decisions. Imagine this. It's 9:30 a.m., the U.S. stock market just opened, and a trader spots Tesla shares jumping from $240 to $241. He owns 1,000 shares, and in less than 5 minutes, he's made $1,000. Sounds easy, right? Well, if that price had dropped by $1 instead, he would have lost the same amount just as quickly. That's the reality of day trading. It's not about predicting where a stock will be next year. It's about what it'll do in the next 10 minutes. Traders spend hours glued to their screens, scanning charts and watching news alerts like hawks, all hoping to catch tiny market movements before everyone else does. The reason it's so intense comes down to volatility and leverage. Volatility is how much an asset's price moves in a short period, and day traders love volatility. The bigger the swings, the bigger the potential profit or loss. Then there's leverage, essentially borrowed money that lets traders control a larger position than they actually own. For example, using 4-to-1 leverage, a trader with $25,000 can trade $100,000 worth of stocks. It amplifies gains, but also magnifies every mistake. And unlike investors who hold for years, day traders don't like surprises while they sleep. That's why they close all their positions before the market closes. No overnight news, no earnings shock, no panic at 4 a.m. when they check their phones. In short, day trading is like sprinting through the financial markets. The goal isn't to run far. It's to be fast, precise, and out before the clock hits zero. Day trading isn't limited to just one market. It's a global playground where money never really sleeps. Depending on what time zone you're in, there's always something moving somewhere. Let's break it down. The most common battlefield is the stock market, home to household names like Apple, Amazon, and Tesla. This is where most beginners start because it's familiar and heavily regulated. The U.S. markets, NASDAQ and the New York Stock Exchange, dominate global volume. Every trading day, over $400 billion worth of stocks change hands. It's fast, liquid, and filled with opportunities, if you can handle the pressure. Think of it as the Formula One of trading: high speed, high risk, and unforgiving of errors. Then there's the Forex market, short for foreign exchange. It's the biggest market on the planet, with a jaw-dropping $7.5 trillion traded every single day according to the Bank for International Settlements. It operates 24 hours a day, 5 days a week, which means traders in London, New York, and Tokyo are all connected in one continuous global cycle. Here, traders aren't buying companies, they're betting on currencies. The US dollar, euro, and Japanese yen are the heavyweights. A tiny move in a currency pair like euro and USD can mean thousands of dollars in profit or loss, thanks to massive leverage. It's where night owls thrive, because Forex literally never sleeps. Next is the cryptocurrency market, the wild west of trading. It's open 24/7, and the volatility is unmatched. Bitcoin, Ethereum, and altcoins can move 10% in a single hour, turning small accounts into gold mines, or ashes. During the 2021 bull run, thousands of new traders joined in thinking it was easy money. By 2022, most learned that crypto doesn't just go up, it crashes twice as fast. Still, crypto's accessibility, no broker, no closing hours, keeps millions of day traders hooked. We also have futures and commodities, where traders speculate on everything from oil and gold to the S&P 500 index. These markets are highly leveraged, and one contract can represent tens of thousands of dollars. That's why futures attract professionals, hedge funds, institutions, and experienced traders who thrive on precision and nerves of steel. When oil prices crashed below zero in 2020, Some day traders made fortunes, while others learned the hard way that yes, you can actually lose more than your initial investment. Finally, there's options trading, the most strategic form of day trading. Instead of buying stocks outright, traders buy contracts that let them control shares for a short period. They're used to bet on volatility or hedge risk. But make no mistake, options move fast. A bad decision can see a 50% loss in minutes. A good one can double your money before you finish your coffee. So how exactly do day traders make money? The short answer, one tiny price movement at a time. The long answer, with a lot of skill, strategy, and a bit of chaos management. Unlike long-term investors who wait years for returns, day traders rely on small, repeated gains. They're not hunting for a 50% jump in a stock. They're happy with 0.5%, as long as they can do it again and again. Think of it like grocery shopping for profits. Small baskets, many trips. One of the most common strategies is scalping. This is where traders make dozens, sometimes hundreds, of trades in a single day, aiming for just a few cents per trade. For example, buying Apple shares at $190 and selling at $190.10. That's 10 cents per share. With 5,000 shares, that's a $500 gain in under a minute. It doesn't sound glamorous, but when repeated consistently, it adds up fast. It's a game of precision, more like surgery than gambling. Then there's momentum trading, riding the wave when a stock starts moving quickly in one direction. Imagine NVIDIA announces record-breaking AI chip sales, and the stock jumps 3% in the first hour. Momentum traders jump in on the way up, surf the wave, and jump out before it crashes. It's the financial version of catching a speeding train, thrilling when it works, painful when it doesn't. Another powerful tactic is news trading. Here, traders react instantly to economic data or company announcements. A surprise drop in U.S. inflation, a strong earnings report, or a sudden rate cut from the Federal Reserve. These can send markets flying. The goal is to move faster than the crowd. Some traders even use AI-powered bots that execute trades in milliseconds, long before a human can blink. And behind all of this is leverage, the magic and danger word of day trading. Leverage means borrowing money from your broker to trade larger positions. In the U.S., regulators like FINRA allow up to 4-to-1 leverage for pattern day traders. That means a $25,000 account can control $100,000 worth of stock. It sounds exciting until the market moves against you, because leverage doesn't just multiply your profits, it also multiplies your losses fourfold. To put it in perspective, even a 0.5% intraday move on a high-volume stock like Tesla or Microsoft can mean a four-figure swing in either direction. On a $100,000 leveraged position, that's $500 in minutes, or minus $500 just as quickly. The secret isn't guessing right every time. It's managing risk, staying disciplined, and knowing when to step away. Because in day trading, the market doesn't reward the smartest person in the room. It rewards the most disciplined one. Now, if you've ever wondered what separates the professionals from the hopefuls in day trading, it all comes down to strategy. Nobody's sitting there guessing, at least not the ones who last longer than a week. Successful traders follow tested systems that help them read the market, not predict it. One of the most well-known methods is breakout trading. Here, traders look for a stock that's been moving sideways, waiting for it to finally break through a key price level, either up or down. Picture NVIDIA trading flat around $480 for days, and then, after an earnings announcement, it blasts through $500 with massive volume. That's the breakout. Traders jump in the moment it crosses resistance, hoping the momentum carries it further. It's fast, it's risky, and when it works, it feels like catching lightning in a bottle. Then there's reversal trading, also known as mean reversion. This strategy bets that a stock that's dropped too fast will bounce back, even just slightly. It's like saying, okay, this thing fell off a cliff, but maybe it overreacted. For instance, if Meta drops 7% in an hour because of a single bad headline, reversal traders might step in once they see signs of stabilization, looking for a 1 to 2% recovery. But it's not for the faint of heart. Catching falling knives can hurt. Another classic is the gap and go strategy, a favorite among U.S. day traders. Every morning before markets open, traders look for stocks that gap up, meaning their pre-market price jumps significantly higher than yesterday's close. This usually happens because of good earnings, news, or rumors. The idea is simple. Buy early when the market opens and ride the continuation. It's like jumping on a moving train. Timing is everything. Get in too late, and you're the one left on the platform watching everyone else profit. Next up is the VWAP strategy, which stands for Volume Weighted Average Price. Think of VWAP as a kind of fair value line that shows the average price a stock has traded at throughout the day, adjusted for volume. Professional traders, especially institutional ones, use it as a reference point. If the price is above VWAP, the stock is generally considered bullish. Below it, bearish. Day traders use VWAP to time their entries and exits with precision, like using a GPS instead of just guessing directions. Then there's the classic trend-following strategy, summed up perfectly by the saying, "The trend is your friend, until it ends." This approach is all about identifying a clear direction in the market and sticking with it. For example, when Apple's chart consistently shows higher highs and higher lows, a trend trader doesn't fight it. They ride it. They use moving averages like the 9-day EMA or 20-day SMA as guide rails, letting the data tell them when to stay in and when to get out. It's simple, but surprisingly effective, provided you don't try to be smarter than the trend. And behind the scenes of all this action is something few people talk about: algorithmic and high-frequency trading. Roughly 70% of U.S. stock trades are executed by algorithms, not humans. These bots analyze data, react to price movements, and make thousands of trades in milliseconds. While human traders are sipping coffee and deciding whether to click buy, algorithms have already made, closed, and logged profits on multiple trades. It's the silent competition every retail trader faces daily: humans versus machines. But despite the rise of AI-driven strategies, human traders still thrive by using one advantage computers don't have: adaptability. They can interpret news, spot irrational behavior, and understand the psychology of other traders. The algorithms might be fast, but they're not creative. If you're finding this breakdown useful, take a second to hit that like button. It really helps the channel. Now, let's talk about what day traders actually use. Because despite what Instagram might show you, it's not 3 monitors and a can of Red Bull that make someone profitable. It's the tools, the data, and most importantly, how they manage risk. Let's start with the basics. Trading platforms. These are the command centers where everything happens. The pros often use thinkorswim, Interactive Brokers, or MetaTrader, platforms known for reliability, real-time data, and lightning-fast execution. For chart analysis, TradingView is a favorite. It's web-based, packed with indicators, and yes, it's where most traders stare at candlesticks until they start seeing them in their sleep. Then come the indicators, the visual cheat codes of trading. Tools like RSI, MACD, Bollinger Bands, moving averages, and VWAP help traders make sense of market chaos. Each one tells a different story. The RSI shows when something's overbought or oversold. MACD tracks momentum shifts. Bollinger Bands measure volatility, basically telling you when a stock's getting a little too excited. And VWAP, the volume-weighted average price, acts like a magnet, pulling prices toward their fair value throughout the day. But even with all these high-tech tools, here's the hard truth. The real difference between successful traders and everyone else comes down to risk management. The pros don't think about how much they can make. They think about how much they can lose and still sleep at night. A golden rule in the trading world is to risk no more than 1 to 2% of your total capital per trade. That means if you've got a $10,000 account, you should never risk more than $100 to $200 on a single trade. Sounds small, right? But this is how traders survive the long game. Because even the best strategies lose sometimes. And it's not the loss that kills you, it's the lack of control. Now, let's scale that up. A trader with a $100,000 account, using that same 1% rule, can risk $1,000 per trade. A few solid trades a week, and that $1,000 a day goal starts to look realistic. Not because of luck, but because of structure. And this is where stop-loss orders come in, the unsung heroes of trading discipline. A stop-loss automatically closes your trade when the price hits a level you set, protecting you from turning a small loss into a disaster. It's basically a financial seatbelt. You hope you never need it, but you'd be crazy to drive without one. The other half of risk control is position sizing, deciding how big your trade should be based on your account size and risk tolerance. Small accounts mean smaller positions, but they also teach valuable discipline. Professionals don't bet the farm. They scale gradually, adjusting size only when their edge is proven. The truth is, day trading isn't about predicting the market. It's about surviving it. The traders who last aren't the ones chasing every move. They're the ones protecting their capital so they can show up tomorrow. Because in this game, your most important tool isn't a chart or an indicator. It's the ability to stay in the game long enough to get good at it. Here's where the excitement of day trading meets the cold, hard numbers. According to the North American Securities Administrators Association, between 80 and 90% of day traders lose money in the long run. That means for every 10 people chasing quick profits, maybe one walks away with consistent returns, and even they have battle scars to prove it. Why do so many fail? The answer isn't the market, it's psychology. Greed makes traders hold on too long. Fear makes them sell too early, and overconfidence convinces them they've cracked the code after one lucky trade. It's human nature trying to outsmart math. Take a typical beginner. They start with $5,000, make $300 on their first day, and suddenly believe they've unlocked Wall Street's secret. The next morning, they double their position size, only to lose $600 in 10 minutes. The cycle repeats. Panic, revenge trading, bigger losses, more caffeine. By Friday, the account looks like a crime scene. Common mistakes include over-trading, jumping into every tiny move, chasing losses after a bad day, and ignoring risk management altogether. Professionals, on the other hand, trade less but smarter. They know missing a setup is better than forcing a bad one, because in trading, survival is victory. The ones who last understand that making a living from the markets isn't about adrenaline or luck. It's about discipline, patience, and respecting the fact that the market doesn't owe you a single dollar. Let's look at what day trading actually looks like when it works, and when it doesn't. Because behind every screenshot of profits on social media, there's usually a very different story. Take Ross Cameron, founder of Warrior Trading. He's one of the few who shows both his wins and his losses publicly. Ross built his career around the gap-and-go strategy, buying stocks that spike at the opening bell because of fresh news or momentum. On a good morning, he can make thousands within minutes. But he's also been brutally honest about the flip side. When markets go quiet, even his system struggles. He's shown losing streaks that would make most beginners quit by lunchtime. His transparency is rare, but it proves a simple truth. There's no such thing as a strategy that wins every day. Then there's Timothy Sykes, a name every aspiring trader has Googled at least once. Tim turned a $12,000 bar mitzvah gift into over $1.6 million by trading penny stocks in college. He's living proof that it's possible, but his real lesson isn't about the money, it's about discipline. He still preaches rule number 1, cut your losses quickly. In other words, don't get emotionally attached to a stock that clearly doesn't care about you. And then came the crypto boom of 2021, when it felt like everyone with a phone became a day trader overnight. People were flipping Bitcoin, Ethereum, and meme coins like Dogecoin during lunch breaks, and for a while, it worked. Volatility was sky high, and fortunes were being made in real time. But 2022 arrived like a hangover. The market collapsed, and thousands of part-time traders watched their gains evaporate faster than a Binance withdrawal. It was a masterclass in volatility. The same thing that makes trading exciting is exactly what makes it dangerous. The takeaway is simple. Even the experts lose. Every professional trader, no matter how seasoned, has taken big hits. The only constant in this game isn't profit, it's risk control. The best traders don't try to avoid losses. They make sure no single loss can take them out of the game. Because surviving to trade another day, that's the real win. Day trading sits in that strange space between freedom and chaos. On one side, it offers what everyone dreams of: flexibility, unlimited income potential, and a front-row seat to how money actually moves in real time. You're your own boss, you work from anywhere, and you learn more about the market in 1 month than most investors do in a decade. That's the reward, the thrill of being in control, the satisfaction of turning knowledge into profit, and the excitement of knowing every day is a fresh start. But the other side of the screen tells a different story. The risks are just as real, maybe more. Day trading is stressful. It demands constant focus, emotional control, and the ability to accept loss without letting it spiral. Burnout is common. Even seasoned traders joke that they measure their success by how calm they stay during chaos. Financial loss is inevitable. There will be red days, and sometimes those red days come in streaks that test your sanity and your savings account. A famous saying captures it perfectly. Day trading is simple in theory, but brutal in practice. The idea sounds easy. Buy low, sell high, repeat. But in reality, it's a mental and emotional endurance test. You're competing against professionals, algorithms, and your own impulses, all at once. If you can handle the pressure and manage your risk, the rewards can be life-changing. But if you treat it like a shortcut to easy money, it'll remind you very quickly that in the markets, tuition is always paid, either through education or through losses. So can you really make $1,000 a day from day trading? The answer is yes, but not easily and not without discipline. Most people lose money not because the market's unfair, but because they treat it like a game instead of a business. If you take one thing away from this video, let it be this. Success in day trading isn't about predicting the next big move. It's about protecting your capital long enough to learn how to play the game properly. Thanks for watching Finance Simply Explained. If you got value from this breakdown, make sure to hit that like button, subscribe, and turn on notifications. And check out my next video, The Psychology of Trading, Why Most Traders Fail. It might just save you from becoming one of them.